Up YouTube? This is the Working Investor. This is a wild start to the month. $168 in premium already collected off the table. The trades that are done. Running return for 2 days of trading, 46% annualized return. Average day to expiration, 1.66 days to expiration. My last month we hit $2,000 a month. Of course, that's not my goal. I want to make it my goal, but I need to be able to prove to myself that I can hit a higher goal than $1,000 a month. When you look at a big goal, you need to break it down into small steps, and you would be so surprised how you just focus on your daily steps, how you can achieve massive success. So $2,000 a month could equate down to a $100 per day goal. We're talking about trading days in the month. There are 5 trading days, Monday to Friday in the month. So let's say you try to have a weekly goal of $500. That would give you $2,000 in the month. Considering that there are 20 trading days in a month, some months can vary because some months you can have holidays. But again, a calendar month is 30, 31 days at most times. And we're talking about actual 4 weeks, which is 28 days. So you may get an extra day or so from the extra 2 or 3 days that we're not putting into consideration. So I would say roughly 20 trading days, more or less. So some of my positions I had in IWM, I've been getting back between $20 to $30, maybe even more. I'll show you some open trades right now. You can see here I have an IWM. If you look at the second bottom line, I have a covered call. My cost basis is 202, and my cover call is at 202. So if it goes above 202, I sleep well tonight because I am at my cost. I try not to sell below my cost basis. This was a roll. I rolled it out from yesterday to today. I have $24 in the roll. This $35 was what I rolled out, and that was also a 202 cover call. That was just 1 day to expiration. So because I rolled it out, I received the entire $35, and I have $24 net so far for tomorrow if I let it go until expiration. So $35 there, $25 coming on. I did sell another cash secure put. So we call this a covered strangle. Why a covered strangle? Because a covered strangle is a covered call, and at the same time you have a cash secure put on the same expiration. Both are expiring July 3rd. Both were put on the same time, or expiring the same time. And the market can only go up or down. You can only lose, technically, I want to say lose in one trade. Like if the market blows beyond 202, my cash secure put is, I collect all the premium, and what happens? My shares get called away at my cost basis. Big deal. The whole point of it was to make money. If it goes below the 201, then I will be assigned 100 shares, and now my average position with cost basis will be a little bit reduced, and I would do cover calls against. I would have 200 shares to run cover calls against, and I could do another covered strangle. So that's a nice way how to kind of step your way into a position step by step, getting your cost basis lower and lower. That's a strategy I learned from The Outlier. He is a YouTuber out there, phenomenal experience in trading for over a decade, is what I understand. So I don't always calculate my deltas when it comes to the covered calls, because my biggest objective with a cover call is to try to sell it above my cost basis. I don't care that much about the delta when it comes to the cover call on against your cost basis. If I would be below my cost basis, I would be very scared, and I'd have to watch the market more carefully, and I would be more mindful of maybe having like a 0.16 delta or lower, because I want to be at least a standard deviation out of the money. But I don't care. I'm happy to lose this position because I will still become a net winner. So that's why I don't always have to track I don't care so much about a cover call if I don't care about losing those shares. But when I put in a cash secure put, I do try to look into the deltas to keep an eye to see what's going on. So this is the big, you can see here a lot of IWMs. My Google video I put out yesterday, I actually did go ahead with it in a different way, in a different account. I did it in my retirement account. So basically, I initially wanted to do a cash secure put yesterday in Google, a 175 cash secure put. Obviously, Google went up because it was trading at 182, and I think it went close to like 190 or something, 185 and a bit. So I actually closed it out for a $22 profit. Again, you say $22, but my goal is to get $100 a day, and you got 22 here, 25 there, 30, 25 there, 35. Things add up. Things add up. I do have some positions on. When you see the 168 over here, that doesn't include positions that are open that are due to close tomorrow. I may close them tomorrow morning. So we'll see. We shall see. So basically, to go back on track over here with the Google, I wanted to have exposure to the upside of Google, but I wanted to be more capital efficient. So in my retirement account, I did buy a leap option in Google because I wanted to use about a third. I wanted to be 3 times more efficient. So I bought Google was trading at 185. Of course, it was the peak, but I still have a bullish thesis on it. The expiration is 12/28/26, put on July 2nd. 899 days to expiration. It was a 150 leap option. It was approximately 0.78 delta. And I put up $6,250 versus $18,000. I put roughly about a third, about 33%, a little more than 33%, 35% ish. I had to pay a brokerage fee, but basically, I mean, this is just the P&L going right now, but I have a lot of time for Google to be correct. So I did sell. I do have long exposure to Google. Of course, if Google goes down, I could be in trouble. I have a risk of not losing 18,500. I meant to say 18,500 because it's 180. But I am, risking 6,250. But I have, my break even, my cost basis would be 62.5 plus 150. So it would be around, if my math is correct, 112.5. So I did sell I have to actually plug it in here. But I did sell a 31 day to expiration, 31 day to expiration short call against it above my strike price. I think it was about a 220 strike price. I don't think that Google, it was like a point 0 something delta. It was a really low delta. I'm trying to collect. It's a leap option. My objective of the leap option is just to try to see if I could try to get the risk-free rate, as I mentioned in previous videos. Risk-free rate is if you put your money in a high-yield savings account, or if you put your money in treasury product, or a certificate of deposit where there's minimal to no risk. Theoretically, the government has so far not defaulted on paying off their trillions of dollars of debt. But so that's where the confidence comes from. And right now the rates are about 5%, 5.5, between 4.5 to 5.25, 5.5 maybe. Let's say 5% would be the risk-free rate. So when I sell short calls against, my deep in the money call, my primary objective is for P&L gain, to capture the gain in the market, without putting too much capital in. So I have, like I said, I have a 3x upside if Google goes up over the next almost 900 days, 899 days. So it gives me a lot of upside. The leap is just a little extra icing on the cake, and I try to make sure initially it's going to be far out of the money. But as there's positive drift, with certain underlyings, I could go a little closer to the money and a little closer to expiration date and get, more meaningful returns, as long as I'm above my cost basis, because I'm here to make some money. So that's the goal. So, like I said, I'm implementing the IWM, some TQQs, which is the triple leverage NASDAQ, TNA, which is triple leverage, Russell 2000, some high yield dividends. High yield dividends, I'm not sure if I mentioned before, let's say if I do like the Yield Max ETFs, these are synthetic covered call ETFs, and it's not diversifying. If you're long for the big stocks like the triple Qs, going into the synthetic cover call ETFs will not shelter you from a down market. But the only difference is it makes your portfolio a little bit more passive. So, and it's also run by a professional portfolio manager. So maybe it helps. It's just a little twist with it. But if there will be a downward market, I would be down. I'm sure the Yield Max ETFs would be most likely down because they just work on a bullish thesis. And yeah, some poor man cover calls, and again, try to avoid selling below the cost base. I've seen people sell leap options, poor man cover calls below their cost bases. They try to go as far as they can away from the current trading price, and getting very little dividend. But then, if you want to watch the market like a hawk, go ahead, be my guest. But, some people have to work full time for a living and have a full life, and you can't watch the market all day, trying to walk next to, shrapnel. You're walking in a minefield. You don't know whenever it's going to go up. It's going to detonate. So anyways, this is the Working Investor over and out. Again, small baby steps, small goals will yield into big goals. Keep doing what you're doing, guys. The work is a journey. Get your freedom, get your life back, get your time back. This is the Working Investor over and out.